Brad Williams, Frugal Finance. Here's an area that can confuse the heck out of people. Let me clarify. What's the difference between a simple interest rate and a pre-computed interest on a auto loan? Pre-computed interest. Be sure when you're doing any type of borrowing to understand the difference between pre-computed interest and simple interest. Pre-computed interest results in the total interest due under the loan being calculated immediately. What does that mean? That means if you have a $10,000 loan and they add the interest over a 5-year period and they say this is a pre-computed interest for 60 months, that interest will be tacked on to the loan amount and there's no negotiation. It is the worst of the worst. If you prepay your loan, if you sell the car after 3 years, that interest will be due. Make sure that you're not dealing with some sleazebag who throws in a pre-computed interest rate as opposed to simple. This pre-computed interest is then spread equally among monthly payments. Simple interest, on the other hand, which is called an amortized loan, which is far more common, calculates the interest based on the outstanding balance of the loan, either on a daily or monthly basis. Pre-computed interest is an uncommon way of calculating interest payments for your auto loan. It benefits the lender if you pay more than the minimum balance each month or pay off your loan early. If you plan to pay your loan off early, you want to make sure lenders are using a simple interest rate, which is generally more common. Simple interest rate, the simple interest rate formula, also referred to as amortizing rate, calculates the interest owed on a daily or monthly basis. The amount of interest you pay each month is calculated based on your actual outstanding balance on the day your payment is due. If you tend to make more than your monthly payment each month, the amount you owe or your principal gets smaller as you pay down the loan. If you want access to this article, the link will be posted below. Pre-computed interest rate. With a pre-computed interest rate, your interest is added to your principal at the beginning of your loan and then split into monthly payment. This formula allocates more of your payment to interest during the first part of your loan. Making extra payments does not reduce the principal amount or interest owed. If you're planning to pay off your loan early, a pre-computed interest rate would mean you're ultimately paying more in interest. However, you may get a refund of some unearned interest. Be careful, be careful. Comment. Let me know if you've been caught up in this spider web. Let me know if you've been trapped in this and if you were able to negotiate out, or were you ultimately stuck paying a lot more for your loan. Brad Williams, Frugal Finance. Hope that helped. Thanks for watching. See you soon.